Nair with NIPay. And as you've seen, this meeting is being recorded. I want to thank you all for coming. Let's get some of the logistic items out of the way first. Please stay on mute unless you want to ask the question. The easiest and the preferred way to ask a question is to type it into the Q&A panel on the Zoom. We will keep going until 7 o'clock. Please remember to stay after. There'll be breakout sessions and we'll place you in separate rooms. So that's pretty much the logistical part of it. Before we begin, NIPay is a nonprofit organization devoted to education around payments, founded around 2010. We want to extend our heartfelt thanks to people who make it possible, to our annual sponsors, DWT and Future Advisory. We're actually quite pleased to have one of the DWT lawyers join our panel. This is an exciting panel and an exciting time. We were just chatting amongst ourselves how everyone is talking about crypto. And when we started thinking about this panel, we were really interested in what was happening to FXT. But now really, FXT is just a piece of a mosaic of what's happening in the industry overall. And we didn't know which dominoes are going to fall at the time, but then Silvergate went and Signature went, and now Binance is in various stages of trouble or scrutiny. So what we're going to do is really talk more about what does this mean? And with us is a wonderful panel. I want to start by introducing Bart Hunt, who is our moderator. I knew Bart when he was a partner for crypto for IBM, but he's done many more things since then. And he was in charge of the crypto practice at Capgemini before he went to IBM. But I'll let Bart introduce himself and introduce the panel. Take it away, Bart.
Thank you. Thank you, Gene. And it's a pleasure to be here with the NYPay team here. So just a little bit about myself. So I'm the founder of Rethink Ledger. So after my stint at Capgemini and IBM, I started my own consulting firm. It's focused on financial innovation, and we use smart contracts and do smart contract programming and work with digital assets. We work mostly with banks, and really focused on bringing their financial products to the latest trends in digital asset tokenization. I'm also the founder of the Digital Asset Innovation Council. This is a community organization of bankers and technologists in Charlotte, where I live, work, and it started out basically to share more insights and opportunities with respect to kind of the broad term of digital assets and bring that that innovation further down in the financial services sector. So that's about me, but I have a well-esteemed panel here with me, so I'll do a quick introduction for everybody. So we first have Maggie Sklar. She's a banking and financial services partner at Davis Wright Tremaine. She served in the government, including at the CFTC as the senior counsel to the CFTC chair. And to the senior counsel of LAPS CFTC, which is a senior counsel to the commissioner. She's an associate director she was an associate director for international affairs, special counsel in the division of market oversight. She also was the senior policy advisor and director of international engagement for financial markets at the Federal Reserve Bank in Chicago. And finally, she's the chair of the Global Digital Asset and Cryptocurrency Association Policy and Regulation Committee. Then we also have Samantha Pelosi. Samantha Pelosi is also an attorney, compliance officer, and former banker regulator. with expertise in digital assets, payments, and combating financial crime. She joined Cube Group recently, which is a startup crypto exchange, as the Chief Compliance Officer and Regulatory Counsel. And prior to Cube, Samantha worked at an NFT platform, some major international money transmitters, and the counsel and a consulting and global law firm. She developed regulatory policy at the American Bankers Association, the Federal Reserve Board during the financial crisis, and FinCEN following 9/11. And then finally, we have Joe Medioli. Joe is actually, found out, a former colleague of mine while I was at IBM. But currently he's the growth and strategy lead for Anchorage Digital, focused on several core business lines, including B2B brokerage services, settlements, and platforms. And prior to that, he was engaged in consulting, regulatory strategy, and management consulting for Promontory Financial Group, which was part of IBM, where he covered core risk verticals, including digital assets, BSA, AML, OFAC, ERM, and board and senior management governance, InfoSec, and BCP. So a whole lot of different topics. So that's kind of the panel. So let's kick it off right away and kind of get into the details. And we mentioned, this kind of panel and topic started with FTX collapse, right? So about 6 months, that kind of happened very quickly. So let's first dig in what really happened at that time, and maybe some of the triggering points or the underlying reasons for that collapse. So Samantha, can you kind of give us a little bit of highlights on that?
Sure. We are at this jumping off point, but just as Jean had kind of mentioned, we really want to talk about the implications, but I'll give a quick summary of what I think happened. We're still learning more juicy details every minute through the bankruptcy proceedings. But I believe what happened was CZ of Binance, who had quite a large investment in FTX, kind of saw the mismanagement and just wanted to take his funds out. And that caused essentially a liquidity crisis for FTX because they couldn't buy back all of the coin and give CZ fiat back because they had taken all of their investors' money and fraudulently just lent it over to Alameda to keep Alameda propped up. And so they were going to have to sell assets and few reserves and cash like instruments they did have on hand. And they just couldn't pony up the money essentially. And when this was, kind of shown to the world very publicly on Twitter and elsewhere and on the blockchain itself, it was just a typical bank run, meaning everyone wanted their money out of FTX and wanted their coins cashed in for either to just take them out of FTX altogether, transfer them out, or wanted actually their fiat currency or wanted Bitcoin or whatever back and wanted out of FTX. And of course, that just, led to the downward spiral. We came to find out pretty shortly afterwards that it really had nothing to do with crypto, the demise of FTX. It had everything to do with young, inexperienced kids running a huge corporate machine without any corporate governance whatsoever, paying, payroll on Venmo or whatever they use. And basically, just having no governance, no bookkeeping, not knowing where their assets were, how much they had spent, how much they had lent. And it was really just fraudulent use of investor funds without the investors' knowledge, and really had nothing to do with the volatility or anything really about crypto itself. I also think, sadly, at not really wanting to throw another regulator under the bus, being a former regulator, but I think, the Bahamas regulators just didn't have a good handle on anything that was going on behind closed doors, and so and we're pretty lax about examining and making sure that everything was above board there. And of course, it all came tumbling down, and it was not above board.
Yeah,
That
thanks.
set the
Thanks.
dominoes. That set the dominoes falling.
Yeah, so that event, and I remember it vividly, had immediately some downstream effects, and you could say kind of was the start, or the continued start of what is called crypto winter, like a downturn in anything related to Bitcoin, Ethereum, or other cryptocurrencies, and even correlated digital assets, right? So we saw the NFT market kind of tank as well. So question for Joe: what did you see around that time? Some of the immediate reaction from different actors in the space, and I'm thinking about investors, and maybe cryptocurrency holders, exchanges, and then we'll also get into the regulatory space a little bit after that.
Yeah. It's interesting. You're just going back quickly to your point about crypto winter. I mean, arguably crypto winter that year started in the summer following Celsius. So, investor confidence generally across the industry was already not in a great place. By the time, October and November rolled around with FTX. I think what I saw and what we saw at Anchorage, we're primarily an institutional facing business. And so our face off is against the hedge funds, the VCs, the sort of protocols, traditional market makers, and well, to the extent that you can have traditional market makers in digital assets. And what I think was interesting is that, that industry itself, of course, pulled back to a degree. Everybody did. It was the right thing to do. But they also, as a, business matter, right, bake volatility into their expectations. So we didn't actually see a huge change in our own customers. In fact, what we saw, which I think has continued to be a little bit of a trend here, is a flight to quality, right? What FTX exposed was, what Samantha alluded to, which is just fraud, right? Operating, companies that were operating either outside the realms of sort of good regulatory environments or operating in a very opaque manner. And so we saw a lot of the institutional participants move back to, U.S. institutions, particularly regulated ones, and then draw back. And I think that has sort of continued to be the case since FTX, and since we've had other dominoes that have fallen since then. What I think has been interesting on the sort of indirect side is that what was very clear is the drop in, we'll call it retail investor confidence in this space. And so we saw a really, really steep drop there. And that, of course, had impacts on the retail facing exchanges. It had impacts on a lot of the traditional banks and financial institutions that themselves were actively or on the cusp of exploring offering digital asset products and services themselves. So folks who had been maybe within a couple of months of maybe launching their first foray into this space, either internally or with partners, pump the brakes on, and frankly, the brakes are really still there. And so I think we're in this interesting time where, even though we're 6 months out, we're still waiting to see, who else is going to fall. But I think the sort of silver lining in all of this is that there is an overwhelming mood of like, whoever survives this as an industry as a whole is going to come out a lot more resilient, particularly in the US. I think we'll all end up agreeing that the lack of regulatory clarity in the US persists, but it will still move towards a sort of better operating model down the line. So I had one colleague refer to this as our Bubba Gump shrimp moment as an industry, right? The hurricane is blowing, all the other shrimp boats are forced onto land, but as an industry, the survivors, the folks who are holding on, are going to come in, and it's going to be all the better for it.
Yeah, so it's not only the retail investors or the retail holders or investors, but we also saw a reaction from regulators and maybe even Congress. So Samantha, what did you notice around that time that was happening and continue to happen from a regulatory perspective?
Yeah, one of the interesting things I think was that immediately came out was that Sam Bankman-Fried had been really actually a masterful lobbyist in Washington, where I'm based. So he had been going around to Congress and really trying to steer Congress. They were thinking about, what should the regulations be for this industry as other jurisdictions move forward with their frameworks. We don't really have a good framework. We have what little regulation we have, it's all FinCEN and anti-money laundering, or at least back then. And then a lot of enforcement actions by OFAC, and then quickly following, the SEC. So they were working on several bills, and Sam Bankman-Fried was trying to steer everyone, including the industry, other industry players and competitors, into thinking that crypto was a commodity and being regulated by the CFTC, where Maggie is, or was. So instead of the SEC, instead of anything else. And it really comes out to show that they were pretty free with the money and giving campaign contributions to both sides of the aisle. And one thing, just being in DC and living here for so long, that I'm really worried about is that there's kind of a freezing effect on Congress. I think Congress and the regulators still need to have a lot more regulation and a lot more education in this area. And there's now been a freeze on meeting with industry because they don't want to be seen as taking handouts from industry or being somehow corrupted by this new money. So that's one effect. Another effect is that there were a lot more bills introduced right away by Warren and other people in Congress that really started focusing on. Warren's known for, her consumer protection bent, but she leaned right in on corruption and money laundering, et cetera, quite strongly. And so there was an uproar. There were lots of congressional hearings and, of course, the bankruptcy proceedings and the representatives of the unsecured creditors, who were the customers and investors in FTX, they were hauled before Congress and continuously have to kind of keep Congress abreast of what they're learning and finding as they unravel the mess.
So one thing I want to add just to Samantha's point that was happening, I think, leading up to FTX and was sort of accelerated into where we are in January, February, is also the prudential regulators who were sort of quietly, encouraging is probably a strong word, but basically, implying that it was not a good idea to bank companies in this industry. And so the theme of debanking folks from the traditional financial system was sort of ongoing into and up to FTX, and then really came down hard after that. And so I think there was a little bit of an ironic twist here, which was, forcing a lot of companies to look elsewhere out of the US financial system, which in and of itself sort of creates a little bit of a ripple effect. And people are still feeling that now, right? The handful of banks that were banking crypto generally really fell like dominoes 3 months later, not for the same reasons at all as FTX, but that creates a big hole in the industry now that folks are still recovering from as well, and was certainly accelerated by FTX.
Yeah.
So the OCC had been very pro fintech, and under the other administration, the Trump administration, and kind of really open to embracing innovation and trying to help it along. And then the OCC under the new administration started walking back, especially with prior even to the meltdown, started walking back it's encouragement to banks to get into this area, or at least letting them get into this area. They started walking back all of the pronouncements under Brian Brooks, and really kind of warning banks to be super careful and to get prior consent essentially from their regulator before entering into this space. And then afterwards, the de-risking began, as this is just way too risky, and banks should in no way be involved, because you're going to have to hold assets like in equal amounts to the crypto assets you have on your books. Let's get Maggie involved in our combo.
Yeah, I was going to say, Maggie, you're a former regulator. I've been close to a lot of these, while you were there, or kind of after you've left. So what's your perspective on kind of the whole situation, and currently around, maybe any challenges that exist regarding regulations in crypto and crypto exchanges?
Sure. So that's a very large question. So I'll take it in bites, because I don't want to dominate the conversation either. I mean, there's, on the banking side, my experience being at the Federal Reserve, I knew about what is being called Operation Choke Point well before it became that sort of name. And it is, there's a strategy there. It's a Biden administration strategy. In 2024, it may change, but in the meantime, it does tie up capital and liquidity, while people and force maybe some companies outside of the United States, while they're trying to figure out what to do in the next year or so, or not. It's not a crypto friendly environment in many parts of the government. I mean, a lot of focus from a lot of my colleagues and friends too, from the SEC side, and see the enforcement actions, but having been at the Fed side, it's not a friendly environment there too. So, we'll see where that sort of winds up. I mean, it's partly a political problem. It's a legislative problem too. And we'll probably get into some of these questions as well, but until Congress sort of gives a directive to some of these agencies, we just don't know. I mean, Chair Powell, when I was there, was very clear about it internally. He's been very clear about it externally, that unless Congress says something about like a CBDC, for example, it's not going to happen. The research has happened, the policy making, the fintech sprints we did, all that stuff happened. But the actual occurrence of it, or figuring out the policy effects of people who are in the stablecoin business, right? Circle and others who've already created these stablecoin initiatives. In other, obviously when it comes to the Fed as well. I mean, we can't avoid Silver Bank and Signature Bank and SVB, right? I mean, like Silvergate and Signature ties to FTX, crypto banking friendly, and runs are runs though. And there was a 2018 rule that made them less susceptible to my colleagues, examinations of banks. But that went through, and that was the law, and that's what happened. And then you have others, Silicon Valley Bank, SVB has no direct link, but because it does crypto and fintech and startups, there was a run on them as well. And there, it's sort of the, there are very few banks that are available to people in this industry, including the people that want to do good. And I guess we'll get to this point too, but I'll just say it now. Some people really want to do good. They want to register and do things, and they want to, get Fed accounts and be registered by the Fed, but it's really hard when you can't. And so some of these things are happening, and it just, when they're crypto specific, but there's nowhere to get a crypto bank. If you're a crypto firm right now, like I'm a member of the, a founding member of the Association of Women in Cryptocurrency, which is meant to try to help and encourage women in fintech and cryptocurrency to be involved, be present, because it's a mostly, frankly, male industry. They couldn't get a bank account anywhere for like over 6 months. Like Covia, I mean, just like name a bank, Bank of America. I mean, like no one would give them a bank account, like a bank account to take membership funds, like not even trading crypto. So that's on the Fed side. You know, it's there's a problem there too, because don't we want, you know, these, I would take that as an aside, but like, you know, just even like for exchange money and broker dealer money, you know, if certain legislation goes through, don't we want the money to be in US regulated banks that are being examined, like properly being overseen by the Fed or OCC, you know, also maybe the SEC, depending if they broker dealer or intermediary connections. Like, don't we want that? I have lots of other things to say about other things. But I don't want to,
I mean,
I think I'm probably off of the outline part, but like, you know, when we get to do we have laws or regulations from preventing FTX, I'll come back to you, but I want to let everyone
Okay.
jump.
well, all I was going
Well-
to say, Maggie, was like share your perspective on this. I mean, we're like Anchorage Digital is like the beneficiary of the last acts of the Brian Brookson administration, and right now we remain the only OCC chartered institution in this space. And it would be really nice if we had more institutions that the OCC could pay attention to, as well, while we're sort of building up our book, right? Like it's an interesting spot, but you know, we're kind of an N of one in this space right now for the reasons that you articulate. Like we want that. Like we're big believers in separating custody from execution, right? And what that means for exchanges and safety and soundness. But it's very hard when you're the only one in this space, and it's quite an uphill battle.
I really
Even
think
getting bank
that-
accounts as a bank.
Yeah, it's really kind of sad. I think in the US that we are not a little bit more together. On the flip side, let's just remember that banks are regulated by banking regulators, and that's what all these regulators are. They're not money transmitter regulators, which is what a lot of crypto exchanges have been up until about this point, when the SEC has really gotten quite aggressive in bringing actions against folks for selling securities, what it deems to be securities. So there are money transmitters, and money transmitters are regulated by the states in the United States. So there's not too much the Fed or the OCC or, you know, the CFPB could really do on that front. And I was in the payments division of the Fed and the consumer protection division of the Fed in DC. And my boss, when I mentioned in 2012, you know, well, maybe we should have, and there was no central bank digital currency back then, no such phrase, but I was like, why don't we, instead of printing cash or having the Treasury print cash, and it's this total waste of energy and fossil fuels, and it's really dirty, messy business and insecure business, why don't we have a Fed Bitcoin? And he basically thumped me on the chest and said, over my dead body, will there ever be a green, you know, a digital greenback? And I was like, okay, I don't have a horse in this fight, a horse in this race, you know, but they've been pretty negative about it the whole time. And I'm not sure, we can get into the details later, I'm not sure we need to have a central bank digital currency in this country because we have so many different ways of paying, but it's really important outside the country. But I think that the whole industry is really feeling the pressure, the lack of any kind of clarity, being worried that can't get a bank account, is going to get fined by the SEC, can't get access to the payment rails of the Fed. And so people are headed offshore, and we've seen already a bunch of folks leave and more on the way. There was just an announcement yesterday that Coinbase got a license it was the Bahamas, right? Bermuda, that's right. And is headed offshore. And even the UK, so they've opened up their central banks payment systems to fintech, but we're not able to bring them on fast enough to do the integration. So there's a lot of complaints there when that happened. And that happened a while ago. And then secondly, they said, bring all your applications to get registered with us. And it was a disaster. They couldn't get through them when folks did come calling for a license. And so they've headed offshore too, because they've had to close down. They ran out of time to get their license. Their license was in limbo. So it's really outside the US that's going to benefit from our lack of organization and lack of leadership, really.
Yeah. So obviously it was a big impact, and there's all this collateral damage that happened with FTX, right? And we all acknowledge that FTX was in the Bahamas, and you mentioned a little bit of lack of oversight over there. But if we kind of portray this back to the United States, and I'll throw this question back at Maggie, right? So we have some very important crypto exchanges here in the United States. They're under regulatory regimes. What's your opinion? Could we have a similar situation? Do we have the laws or governance in place? Should we be afraid that something like an FTX could happen again, and could happen with some of the crypto exchanges in the United States?
Sure. Thanks for the question. I mean, I want to just comment real quick on the last comment. One of the things I speak about when because I speak about this topic regularly, and including externally, but also internally with regulators and senior staff, I still know, like, bring it on shore, because at least you could regulate it. You get data. There's no data. There's no regulation from the outside. But, do we have the laws or regulations? Like, let's talk about FTX in particular, right? So what we have, no, not for FTX as it existed at the time. I want to distinguish that, though, from the FTX CFTC regulated entity that was in the United States. So I want to just give a little clarity on the differences there, right? So what we have in the United States now, it's not regulation, examination, or audit authority. It's enforcement authority. So in the use of this enforcement authority, which is otherwise known as regulation by enforcement, this authority occurs after the fact, right? So it's after there's fraud, after there's mismanagement. It's a wholly different concept than the way the CFTC or SEC or Feds don't regulate exchanges, but how they regulate banks. But let's just, let's call this an exchange, right? How they would regulate an exchange, it's completely different. So a regulated exchange in the United States is subject to congressionally approved statutory law, to regulatory rules passed by majority vote by commission, staff guidance, staff monitoring, data submission, and examinations and audits. The regulatory regime in this respect is meant to protect customers, protect investors, and prevent the need for enforcement actions. You don't need an enforcement action when you have a really good regulatory regime. And I say this, also being biased, having been an examiner at the CFTC at the start of my government career, but that was my intent too. And I know it's the intent of everyone that's taken my spot, all of my colleagues and all of my colleagues at the SEC, like that, and OCC and Fed, like, this is like your job and goal is to prevent bankruptcy. It's to prevent these types of massive frauds, but you don't have access to this. You can't enforce rules when there aren't rules in place. So, for example, while enforcement actions do serve as deterrent, hopefully, obviously it's like trying to pay back customers and assign to the market to not do certain things. It's a lot harder to help customers after the fact. And most customers do not get anywhere near $1 back on their dollar after the full amount lost. Even MF Global, which is probably one of the best recoveries that happened in parts of these, financial, disasters. I think it was around sense. And that was like the best case, and everyone had to wait like probably around 10 years. But I can tell you, for example, when the CFTC, when I was there, when we confiscated a yacht, for example, we didn't get back the full amount of the yacht to compensate the customers. It's just, that's not how, it's not a dollar for dollar transaction. The best thing to do is to get it through beforehand through regulation and examination. So I'll give an example. If all of FTX, in addition to the CFTC regulated crypto derivatives business, which existed and it still actually exists, had also been part of the CFTC regime, it would have been subject to the full rules. That is customer seg, and that they would have had to be cleared. There would have been customer fund protections, special priority and protections in bankruptcy above creditors, which doesn't exist in. They would have been subject to KYC, AML. They would have had required exchange surveillance. They would have required trading practice surveillance to prevent wash trading between Alameda and their members. They would have had to have a board of directors. They would have had to have a risk management committee. They would have had to have a dedicated chief compliance officer who was allowed to go directly to the head. They would have had to do annual compliance chief reports that had to be certified and notarized under like the perjury of law. They would have had conflict of interest policies. They would not have been allowed to do market maker programs against their own clients. They would have to separate management roles and trading and market maker roles. They would have had to have been examined at least once a year, regular data monitoring, sending data and documents to staff, like subject to request within like, a week or two or sooner rather than later. None of this happened in the FTX context because other than the CFTC regulated FTX business, all of this was outside the CFTC's regulatory regime. So, but I'd also note this isn't a border related issue. I mean, they were offshore, most of FTX, but there are many exchanges, clearinghouses, intermediaries outside of the US, the CFTC regulates it overseas, in London, in Europe, in Asia. They're subject to these same protections, same data, same document requests, same regulatory requirements and surveillance requirements. And I would note too, the SEC does the same thing. There are hundreds, if not thousands, of broker dealers abroad that are subject to the SEC jurisdiction. So it's not a jurisdictional issue. It's just frankly a congressional issue at this point that there isn't the regulatory authority to do that. And it's hard to access bad actors in other countries, and we sort of have to rely on other countries to do that. But it is, there could have been a different result. I mean, you can't stop fraud and bad management without knowing it's happening. But there were so many protections that exist in the United States that just weren't applicable at the time. And, we'll probably talk about whether they should or, could be applicable in other contexts.
Thanks, Maggie. And, a lot of this has come out through, a lot of investigative journalism, the bankruptcy preparation and so on. But, what we all also learned that in crypto, there's very short cycles. And actually, since the beginning of the year, just a couple of months after the demise of FTX, we now see crypto, Bitcoin and Ether like up 70%. So we're seem to be out of crypto winter and into crypto spring. And just so wanted to get a perspective from Joe, where's this going? What's linked to this recent run up? And maybe also give your perspective of what's happening just beyond crypto.
Yeah, sure thing. And, not knocking on wood, Bart, on the resurgence of spring, right? I think we're we're at the early cusp, I hope. I think a big part of this kind of comes back to what I mentioned in the immediate fallout of FTX, right? A lot of this is going to be driven by the large institutional players, and they have a long view on this. And as those participants started to get back into the market, get a little bit more comfortable, we start to see prices incrementally rise. The other piece of this that I think is important is and it kind of gets to one of the more, I would say, interesting knock-on effects of FTX is, I mentioned the real, withdrawal of sort of like retail demand and the impact that had on things like prices around Bitcoin and Ethereum and the sort of traditional volatile crypto assets. What I think that did jumpstart, which was percolating, I think, in the background, the last year or two prior, is this sort of concept of, well, what if we start rethinking again, not crypto assets, but really digital assets as a technology and what that does for financial services. So I think is the same time that people took a little bit of a pause on maybe really investing heavily and, high frequency trading just to hit, arbitrage between Bitcoin prices on different exchanges. We saw folks take a beat and say, okay, well, let's look at this from the perspective of issuing digital asset securities or creating tokenized representations of commodities or other sort of variations of financial instruments that they can now think of a more, we'll call it efficient, potentially cheaper, potentially faster, safer settlement infrastructure. And I would say in the months between FTX and now, I personally, in my day-to-day job, have seen a huge resurgence of that interest in that business. And we're seeing a lot more large-scale financial institutions. I mean, the likes of BNY Mellon and Apollo have made public announcements about this. State Street has done this. In sort of, I would say, a little bit of test cases, like maybe we're going to tokenize them, a mutual fund or something like that. But then in the kind of periphery and maybe some smaller entries, right, we're seeing really meaningful entrance into the space about, new ways of digitizing, commercial real estate baskets or carbon credits. And I think there's a more interesting investment in the technology itself. And I think as you have people sort of gaining their balance again after the crash and looking a little bit more holistically across the industry, confidence is reemerging in the technology itself. And that is kind of a little bit of a rising tide lifts all ships. So as there's more investment holistically, people are tighter with their dollars because interest rates have shifted. And so the investment in new protocols and new technologies is a little more stringent than it was. So the stuff that's coming out new, I think, tends to be a little bit higher quality than it was maybe 8 to 10 months ago. I think all those factors together are contributing to this rise again. So it's not just about Bitcoin being, close to 30K again. It's, Bitcoin being up, but also as a function of the other investment and the sort of safer view of the industry as a whole.
Yeah, I have to agree with Joe that it's it's very interesting to see that there is going to be this like survival of the fittest, first of all, of the exchanges. But then I've just been of the opinion that, again, we probably don't need in a lot of Western nations, another way to pay necessarily and pay instantly and so that was never really the killer app for crypto or for blockchain, really. The killer app for blockchain is anything that needs to be registered and traced and audited. And I went to an NFT company that is solely focused on, art and token gating of events and other things that are much more fun than financial services, because I'm truly believe that financial services, NFTs are going to become very relevant for financial services. This tokenizing of ownership rights of things in the real world, and other, property that's intangible property, like. So it's really interesting. All the other use cases are now starting to pick up in financial services and elsewhere. And that it really is a kind of flight to quality, just like Joseph said. And I really think that one thing about there's been a shift to DeFi. Folks are really interested in DeFi now, because they see the centralized operating model of FTX and really a lot of other exchanges as being the downfall. Humans are at the center of it, and therefore you have fraud and mistakes, big mistakes being made. And Bitcoin is the original DeFi, right? It's a protocol that just runs. So I think that is a kind of a flight to safety. I also think as interest rates have increased, that everyone around the globe is interested in having a store of value. And so in places, especially in South America, crypto and Bitcoin and things with a lot more liquidity. A lot of the coins with more liquidity have really become popular as a store of value because they can take their paycheck and move it into Bitcoin. And actually, Bitcoin is less volatile than their own national currency. So I think there are a number of things that are probably fueling the price going up and hopefully a crypto spring. If not, a full out summer, at least things are starting to look up a little bit.
Yeah. And so Maggie, kind of what are your final thoughts, kind of based on what you see, talking to clients, talking to prospects, or where we are today from a few months ago?
About just sorry to rephrase the question, like where we are on FTX or crypto or
the crypto in general.
oh my gosh, that would be my entire week. No, no, I mean, yeah, no, sorry. Can you narrow the question down? Do you want me to talk about more the tokenization part of it, or
if
just
you can,
or
yeah.
to with legislation or what I'm seeing in the industry? Like I do this all the time. I just want to make sure I'm answering your question.
What is your top topic right now, looking at the future, in your conversations with clients? Is it tokenization? Is it around regulation? What are people most interested at this point in time?
So it used to be whether something was a commodity or a security. Happy to discuss that, engage in
Sure.
that, but past that at this point, with the enforcement actions from both the CFTC and SEC, with FSOC papers, with IOSCO and FSB papers, and anyone that's doing this globally, MICA just is done now too. So now if you're in Europe, you're going to be following what they say anyway, and it's going to trickle down into the United States because you can't. It's just always easier to follow the most stringent regulation. So for us, for Dodd-Frank, for example, we were we were the most. One second, let's see. It's very dark in here. We were the first, right? So people followed us for the most stringent sort of regulations for like swaps, right? Preventing the financial crisis. But when it comes to crypto now, Europe has MICA, so and GDPR, the data protections there are more stringent than what we have here. And so global companies, and that includes crypto companies. Crypto is global too, right? You wind up tending to follow or have to follow the most prescriptive regulations. So I would say a couple of years ago, I was writing Howie memos and doing that, scale from like 1 to whatever about like whether someone was, an ICO or a security or not. We're like past that at this point, between, what's happening globally, but also happening here, under Gary Gensler's SEC regime, under enforcement cases are both the SEC and CFTC. And so the discussion I used to have, is this under the Howie test? A lot of the discussions and most of the discussions I have now is about the upcoming legislation and the drafts I have access to and the drafts I'm editing for others and working for on behalf of the global DCA, which I get sort of, firsthand knowledge of before a lot of them become public, and then try to help, members and my own clients, like where to help navigate those, because a lot of them are strangely so like the Gillibrand bill last year was very comprehensive. The new version is not going to be comprehensive. it wasn't going to pass. And, given the divided Congress, the way it works right now, they're still debating, does DeFi count in this, right? And so there was a lot of talk last year, right? And a lot of talk with my clients about that. The DCCPA, which was also bipartisan, Stabenow, Bosman, the Digital Cryptocurrency Protection Act, which was going to give the CFTC authority to regulate exchanges, to do what should have been done over FTX, at least my personal opinion, but but because SBF supported it and gave money to them, like now it's like considered like probably dead in the water. I don't think that makes it a bad bill. I mean, you don't usually get people that aren't regulated asking for regulation, but it also means that, okay, so SBF did a bad thing, so that means we're going to throw the whole bill out. It's possible that's what's going to happen. So I hear a lot about that on both sides. Some people think the taint of FTX and SBF is not going to hamper that bill and what was going to be done, which was going to give the CFTC the protection, like the enumerated protections I just mentioned before about customer seg and customer protection and surveillance and conflicts of interest. Like all of that stuff doesn't exist right now. It's in a vacuum. And then there's the DCEA, for example, the Republican side bill, which now that the Republicans have the House, it's a Republican House bill. I like the wording of it because it actually intentionally, I also edited some of the wording of it, but I'm saying like some of the wording of it, because one of the things I face as an attorney, and I'm sure everyone here faces too, and I'm sorry, I'll turn on the light in a second. There's like a thunderstorm coming. For some reason it's making it very dark here. But one of the things I liked about that bill is that, and one of the discussions I had with its drafters is that it separates what a commodity and a security is. And that's the thing that most of the bills are not doing. They just say, well, securities go this way and commodities go this way. And stable coins either go to the CFTC, SEC, OCC, or Fed, depending on what bill you're reading. So, but when it comes to crypto right now, there's the DCCPA would have given certain things to the CFTC, other bills, maybe more to the SEC. None of them super define it. And the DCEA, the Republican bill, which was considered dead in the water last year before the election, is now possibly like in play too. So these are things I talk about with my clients because like as people trying to figure out too, like and I assume maybe people on the call and possibly your clients as well, like are trying to figure out. A lot of them just say to me, well, I'm just going to go offshore, and that deprives them of access to the most liquid markets, the best capital markets in the world, which is the United States. It deprives them of the ability to engage with U.S. banks and U.S. investors and customers in many ways. And that's, not, how I at least see how things should happen. And we'll get to the innovation and tokenization point maybe later. I'm like looking at the time.
Yeah, I'm looking at the time as well, and I really appreciate everybody's kind of inputs kind of on the past and also in the future, but would still want to give the opportunity for a few people to ask some questions. And I'm seeing some coming through and some comments here through the chat. So let me just take a quick look as well. So if people want to kind of put some questions in the chat that are top of their mind here, so it comes to the bottom of my list.
So Bart, people can also just unmute and open their cameras and ask questions too.
Okay.
There's about
Let's do that
3
then.
of us, so feel free to chime in. I wanted to pick up on what Maggie said while you all think, especially about things going offshore. So my crypto exchange just came out of stealth mode, and we are not starting in the US because it's just such a mess, even though we're incorporated here, right? Also, why I joined this particular company is because they're thinking ahead and trying to address some of the problems that we've seen with both DeFi and CeFi, and having really a special wallet and special technology that well, the wallet, first of all, is kind of non-custodial. So we can help a customer who loses their keys, like we could authenticate them and basically get them back into their wallet. At the same time, their assets are not sitting with us. And if there's a bankruptcy of us, then they have their assets safe and sound. So there are like innovations that are trying to iterate on what's gone wrong in the past. Likewise, we're being very transparent about where our funds are and where they're going. And we're scaling the technology as well to have quicker and better matching of both sides of a trade. So it will speed up the processing time. But this is all going offshore, and we're going to release it somewhere else because it's just such a churn here. And it seems like not just the point of, I see enforcement actions as, something really needs to be enforced. There are regulations that need to be enforced, and you're flouting them. And it's really a way to draw a line in the sand. Like, this is really not permissible. So you're getting an enforcement action. It's not the gray cases, but because there's no regulation, there's no telling what's a gray case and how far over the line you really are. I think now in the US, which is very sad. And as I saw in the comments, somebody said we need to keep the technology and the innovation onshore. I mean, this is part of, the US is known for its innovation and its, its entrepreneurship, and it's all going to go offshore. So I think it's pretty sad.
Anybody who has a question, just mute themselves and ask it.
This is Larry. I'll ask a question. I mean, I have my own personal view on this, but do you think we'll see the regulators finally allow one of the crypto or digital asset companies to acquire a banking charter? I know, like custodial looked like they were maybe gonna move in that direction. Of course, it got slapped down pretty hard. There's a bank in Chicago that's being acquired by a crypto company in Houston called Levelfield. That one I actually think might have some chance, but like, do we think we're going to see kind of merging of digital asset companies with more traditional finance?
Well, I think it's been, known for a while, like, right, Bank of New York Mellon has a growing, albeit slow, digital asset business. It's not in-house built, right? It's partnered with Fireblocks. Citi has something of a pilot going on with Medico. State Street has its thing going with Copper. They're all in very different stages. I don't think we're going to see much big coming out of any of those, frankly, anytime soon. Soon is maybe in the eye of the beholder. But Larry, to your specific question, I mean, that's exactly the spot that we're in. Like, we are an OCC chartered bank. We converted in January of 2021, and at the time, Potigo had a conditional charter, and then subsequently Paxos had one. Both of those have expired. So we're it right now. I think the environment's really tough. It's even tough in the state of New York. And so there's even going after state chartered trusts isn't easy right now. It's one of the reasons why a lot of states have opened up their own regimes to try to, I don't know if the word is counteract, but maybe
How about poach?
Yeah. I mean, Wyoming was a great example. When I was on the consulting side, we worked with the state of Wyoming on the Speedy license, right? We helped, sort of draft that in the background. Like that was a really interesting pilot piece of work back then. And a lot of other states have sort of taken on that taken on that approach, but that does not solve the federal issue by a long shot.
Yeah,
I mean, even the most recent proposed custody rule out of the SEC is, a little bit vague on this, but still, implicitly draws distinction between what a qualified custodian is versus what a state chartered trust can do. Didn't go so far as drawing the line, but they certainly upped the ante on, whether or not the state chartered trusts have the capacity to qualify.
Thank you.
Worked on with Custodia and some others, including in Chicago, that decided to sort of back out of Custodia Chicago, and we've worked with Custodia, Caitlin Long, and I've been working with them for years, even when I was at the Fed. And then in Chicago, we had some members that joined Global DCA because they were banks engaging in crypto, and then 2 weeks later we're not engaging in crypto, and suddenly we're not members. But like, they had really interesting presentations. No, it's a tough space to be in, both trying to be a bank in this space right now, and then also offer banking services after that January 3rd missive. So, I know people involved in that. I was at the Fed when a lot of this stuff was sort of going on, Operation Choke Point, whatever you want to call it. And it's tough. And I think until someone really gives a really good litigation challenge, which I know Custodia and, some others are probably going to do, or maybe an administration change, we are where we are, where it comes for certain banks. There is risk adversity, and tying it back to the topic of this panel too, with FTX, it did not help, right? FTX is not a bank and no one cares. It just did not help the situation in the United States when it came to, like, even some people that were warming up to innovation and crypto and digital assets and bank and central bank accounts. In the Biden administration, we are in a different administration than we were in the Trump administration, different than Brian Brooks and others. And so it's just, but it's a slog, and it may just have to be settled by litigation, and it may just also have to be settled by change in the next year, and everyone just sort of needs to hang on or hold on or keep their draft, get their draft banking charters sort of drafted it and try or put them in and do what Custodia is doing too. Like, there's a timeline. There's the Administrative Procedure Act, requires a deadline on certain Fed actions, and it doesn't require certain deadlines on the SEC or CFTC actions. That does on the Fed on certain actions, and like trying to push through that too. But that takes effort, and also being willing to be in the news, which not everyone wants to necessarily do either. But it's a challenge. And like I mentioned too, it's a challenge on the other side too. What I hear a lot about from like my crypto clients is they can't find a bank in the United States when they have crypto in their title of their company. When they're trying to open an account, they're finding it very difficult to find banks. And like Custodia is like where they might go, but if they're in a certain state that requires, like New York, you have to do it through New York. So Bank of New York Mellon does it for like big players, but some of these guys are small fries and startups, and have taxation products and projects that are really cool and interesting, and they're not going to be taken up by big banks. And so it's a problem on the other end too. Like, where do you find a bank? And if any of you guys are banks that know the answer to this, like, let me know, because I'd love to tell people where to go banking, because everyone is finding it a hard time in the United States right now.
Maggie,
there's a list circulating on LinkedIn that I have further circulated of the ones that are still entertaining crypto companies, or at least willing to talk to you.
Yeah, I think it's more willing to talk to you. Go for it, Larry. Yeah.
So, I mean, Caitlin Long's been pretty public. Brian Armstrong's been pretty public. Do you think that is a helpful or hurtful strategy at this point for the crypto industry?
I being a former regulator, and I was in the payments division of the Fed, and I wrote the rules about when you can get access to the Federal Reserve rails, ACH, Fedwire, check clearing, and I wrote those policies. Then I left, and it was very interesting to see, how then the board went out and said, for the reserve banks, how are we going to possibly decide who should get access? They regulate banks. And so in my opinion, I'm right there with Caitlin and to a certain extent Coinbase as well, because it's completely unfair. They are a bank. They are a state chartered bank, just like any other state chartered bank. It doesn't matter that they do crypto and, it doesn't matter. If they have a bank charter, they're eligible for membership in the Fed, and they're eligible for a Fed account, master account, and eligible to have, a direct link into the Fed's services, which are basically a duopoly in the United States. It's only the clearinghouse and the Fed that have ACH, wire, and check clearing. So I think it's pretty ridiculous, actually. And again, the UK went through this a long, it was years ago that they ended up letting fintech have bank accounts. And also when I was in the payments division, they were wringing their hands about big clearing houses, like huge clearing houses like CLS and DTCC. Like they're not actually CLS is a bank now, but they weren't actually banks. So should we allow them to have a settlement account at the Fed? I'm like, they're moving trillions of dollars around, but oh no, they're not actually banks. So I don't know. And it seems like really form over substance in a terrible way. And I don't want saying that out loud, as I just did.
I will say, as I wouldn't even go so far as calling it devil's advocate, but the other side of this is that even outside of digital assets, like being a de novo bank is just very hard, right? It is fundamentally hard. And before I was at Anchorage and I was on the other side and I was advising tons and tons of traditional banks, some very, very large, on just fundamentally understanding this technology in and of itself. I mean, this was a year and a half ago, and I was still giving 14-hour presentations over days to hundreds of staff members at large banks, explaining like, what is a Merkle root? Like, why does this matter? Like, what is blockchain? So like, there is an element of this as well, that there's a level of time in this that actually does make sense, right? So there's a weird balance that we have to achieve. Like, I would never say that this should be shut down. Like I said earlier, like I want more federal banks in this space. I want more real banks in this space. But I also recognize the hesitancy at a lot of the larger institutions to get started on this, because even doing this in pilot, it's expensive. It's not clear how much money it's going to make. The talent pool is very limited, and it's hard. It's a hard business to run.
I think that was a very good summary at the end here, Joe. So, Gene, I think we already ran a little bit over time here, so I want to hand it back to you or the other people from NYPay on kind of organizing ourselves in the different groups. But before I do that, I want to thank my panelists, so Maggie, Samantha, and Joe. Thanks for all your insights, and I think this was a really in-depth conversation. You guys bring a lot of experience to the table, so really appreciate that. And so hand it over to Gene on kind of what we're going to do next.
Right, and so I think it's Nikki who is going to drop us into the various rooms.
Okay, actually, I'm going to take care of that for you, and we're going to put everybody into a room. You'll have a chance to chat with your colleagues there. And we're just going to do one group tonight. So once you're through with your chat, you can sign off. All right, stand by.
Thank you. And so we should be seeing something coming up on our screen, and we click it.
Hold on.
Oh, there
we go. Just want to make sure that people wait for it.